here we are, March 1st. Can you guys believe that 2 months of 2012 is already gone? I mean, that just blew by. I don't even know what happened. But anyway, we're going to start doing this once a month, the first Thursday of every month. And I apologize, of course, my gardener is here right now. So he only comes every 2 weeks, but he's got to catch me at my webinar. So sorry for if that's annoying. I'm going to start up my little HB10B2. Uh, I'm thinking that next month I'm going to be having that the iPhone app or that by in-a-day development. The only thing is on my operating system, I'm too behind. So I can't use their app yet, but I like it the most. So just FYI, this is the old version, probably the last time you guys are going to see this one. So anyhow, okay, so first thing, what I'm going to do is just, the point of these things is just to go over just some really common things that at least happen in my world on a routine basis. So you just get an idea of just how I think and how I put the deals together, and pretty soon you'll figure out how it all makes sense and how you can do, you can do this yourself, and there will be no mystery left, at least in this arena. Although it's always fun because every note deal, especially the discounted notes, most of them are always, a little bit different, just kind of like being a nurse in the ER. You never exactly knew 100% what was going to come in the door, and you had to think on your feet and things like that. But anyway, I'm going to do a clear all on this calculator here. This is, as I've told you guys before, there's 3 ways to invest in notes or in paper. That's to own or carry, be a private lender, or on the secondary market to buy discounted paper from the other 2. So on this case, I had a $50,000 loan. This is a nice property in Pasadena. It's worth conservatively $400,000, and all he needs is $50,000. So that means oh my gosh, really? All right, so here's how I'm going to figure out my LTV, my loan to value. And just as an FYI, guys, I mean, most hard money will go up to 65% of the value of the property. I like to stay at 50% or less. So let's see, 50,000. So I mean, based on the value of this property, the max loan value I would go up to is 200,000. Okay, so divided by divided by 400,000 equals, 12.5 is rounded to 13. So on here I'm only at two decimal points. There's a way to make 3 decimal points if you want, but anyhow. So that's how we get the loan to value, and then I'm charging them a 10% interest rate. So this is how I'm going to figure out what the monthly payments are going to be to for both sides of the party. So 50,000 times, remember it's not amortized at all, interest only payments. See, there's a balloon that equals the exact same as the loan amount. So all I got to do is cover the interest in the middle. So 50,000 times 0.10 or 0.1 equals, okay, that's going to cost him $5,000 a year. So I wonder how much per month. So I go divided by 12, and that is $416.67 a month. And he just needs it short term. The reason he's pulling out some money is to pay off some credit cards and possibly put a down payment on another real estate investment. So it's going to be 24 months payment. I'm going to keep $15 a month as a servicing fee. So if you want to figure out what the true yield is to you, if you were coming in and saying, look, I love this deal, I love the safety, I mean, $50,000 is less than land value. So I mean, you could even have an earthquake and be okay on this deal. Okay, so minus the $15 that I'm going to take for servicing the note, That's how much my investor coming in for this massive amount of safety is going to get 401.67 a month. And then I would say times 12, right? We have to figure out really what it is. So that means my investor is going to get not 5,000 a year, but 4820. But now I want to see 48. So that's my interest for the entire year. So I wonder what that represents. So I'm going to take that and divide by how much money I put on the table, which is $50,000. And this rounds up to 10% anyway. But if you go out farther, it's actually the effective yield is 9.6% to my investors. Still very, very good. Very solid secondary, note money, loan money for this kind of safety. The way that I get paid, obviously, a servicing fee of $15 a month isn't my typical keep a spread in the profit. That's not how these loan products work. They're not built that way to make sense. So instead, what I have to do as a broker is just charge points. So I might charge them 3.5 points. So, and a point is a percentage of the loan amount. So I will take a $50,000 loan amount times 0.035. See, because we know, remember, decimal place two to the right, so it's 3.5%, and that's how I get paid in this deal is $17.50 up front. So when we have loans, when we do originations for our note investments, the way that I make money is charging points, and the borrower pays it. When I'm doing a discounted note, the borrower, nothing happens to their payment. Their deal is already done. The seller basically pays me. If there's a broker fee, it's the seller taking the discount that pays me, and it can be anywhere from 1 to 6 points, I would say, depending on the deal. And this is an investor loan, which is very important. There's very few people that will do consumer loans, even the most traditional guys that have done hard money for years. It's from a regulatory standpoint, it's getting much more dicey to do consumer type transactions. Okay, so this is nice and clean. I wish I had like 2 or 3 of these a month because they're so easy, so clean, and they make sense for everyone. Any questions, comments so far on that? Oh, finally the guy quit with the machine. Okay. Okay, next deal. This is another super, super low investment to value transaction. And remember, anything 50% below the value of the property, I'm interested in for the most part. Okay. So here's the deal, how this is a note purchase, a partial. I didn't even put that. It's a partial that I closed on in February. So here's how this note was created. An owner, a guy that does a lot of real estate investing, every now and then he ends up selling with owner financing, but mostly he just has tons of rental properties across the U.S., but he's got probably a portfolio of 7 or 10 notes all told, and they're kind of spread over the last few years. So he's not doing a lot. Therefore, he's not, in my mind, dealing in notes and doing lending. So to me, he doesn't fall in the worrying about the SAFE Act and things like that. And he put his deal together very solidly. So here's what he did back in September. He sold the property to a husband and wife for $170,000. So let's clear all here. And so $170,000, and they put minus 10,000. How much of a percent is that, by the way, right? Not very much. I mean, it's like okay, but it could be more, right? I mean, what's a traditional down payment that's minimally acceptable normally on an owner occupied? Does anyone know?
10%?
Yeah, 10% is usually the minimum. So this is a little thin. Okay, so I take that into consideration. I like to see a minimum of 10%, and obviously the more the better. Once you get 20% down or more, you're actually into basically conventional underwriting, at least from that standpoint. And if they had a good enough credit score, it would actually be considered like A paper and sell, you could sell that off to funds that deal in conventional grade A paper. Okay. So that's a little thin. The way to get this, just in case you don't know, is you take 10,000 divided by 170 and you get 6%. Okay, 0.06. That left the note and deed of 160,000. It was a first. So that's our PV right over here. And the interest rate he put on there was 7%. So, that's pretty decent. It's higher than you could get at a bank, but it's very fair historically speaking. Where's the average for, I mean, when I bought my house back in 1999, rates were considered to be pretty decent, and I think it was 7 3/4 or 8 1/4 or 8 1/2. I mean, right? So historically speaking, this is still really great. So nobody should go, oh my gosh, he really bent him over on that one. He didn't. That's very fair considering they can't get a bank loan, and that's not really very much down. So then he amortized, so we got there. Now the term, and his term, right? So the term, he amortized it over 30 years, but what did he do right here?
Balloon payment.
Yep. And when?
Um, that's 7 years.
That's right. So he made a 7-year balloon. And normally I really hate balloons, especially on consumer loans, because HUD doesn't like anything that you could potentially set up a homeowner for failure, because what if they can't refinance? Right then, what are you going to do? Foreclose on them? That could be sticky. So I actually, 7 years out is reasonable, but I don't like that 100%. So I would think I really don't want to I don't want to buy the balloon on this. I don't want that what if. I'd like the note seller to think about the what if and not me. Okay, but still, this is a very fair deal. He didn't make I've seen owner occupied consumer carrybacks that had 2-year balloons. That scares me a lot. Even 5 years is too much, but 7 years and beyond is fair. At least if you're going to say, well, I'll extend the loan for him. I just want the chance to renegotiate the interest rate. But don't be in front of a judge with a balloon on a consumer loan. I wouldn't want to be in that position. Okay, because it just looks bad. So anyway, so 360 is the amortization. So, and then we want to get the monthly payment. So we click over here to payment. Oh, geez, what did I do?
Missed the 3 on the 360.
Oh, okay. 160 there, 7 there, and 360 there. Wow, I still did something wrong. See, this is just how it goes. Keep messing around with it till you get it right. And lucky I have a PowerPoint to show me what is right. Why is it doing that?
That's what I'm getting to.
That doesn't make it, that is not how the note went. Maybe I remembered wrong on the, oh, I remembered wrong. It wasn't 7%. It was a 6% note. Okay, because I just bought this one. It's in my memory. So I messed up. This is not 7. The face interest rate was 6. Okay, so it was 959.28. We don't know the credit. He didn't pull it because he knew that they didn't have great credit. They had, like a lot of people, you're doing debt settlements and all sorts of things that mess up your credit. So he didn't do that, and I go, well, that's another thing for me to think about. 6% down is something for me to think about. I don't want this balloon. I know that. I don't know about the credit, but owner occupied, if they that's probably a lot of money to those people, so they probably have a high emotional attachment, so they're going to do everything they can. This looks like a reasonable payment for someone to make. 2 people working in the house. 4 months of seasoning. It closed on September 29th, 2011. And luckily for me, the note holder only needs 30,000. Am I glad about that based on some of these other things? I am. Why? I mean,
It's a little
Gosh.
risky.
God. Okay, I would be in first position here because that means that even if they have super bad credit, even though that's a low down payment, even though only 4 months of seasoning, whatever, gosh, this property could only be worth half of what they sold it for, and I'd still be
Mm.
plenty okay, even after 2 years of no payments. And you see what I'm saying? It would be really hard to lose money at this level. And he only needs this much, and the reason he would sell, because he's a seasoned investor, uh, and he goes, I go, why do you need the money? You look like you have a lot going on. And he says, well, there's another investment I have that if I can get 30,000 now, just shake it up pretty quick here. And I don't, he's looking for time is of the essence. He says, then I can double my money, so it's okay with me if I take a discount, at least on part of this, only sell enough to get what I need. Then later I get those payments coming back to me about the time my oldest son's going to hit college, and then the extra cash flow will come in to help pay for his college. So this is why this would work really perfectly, right, for everybody.
Okay, so how do you buy the note for 30,000? Because I'm looking at, I've got the payment and all that, and I looked at what's left on the balloon payment
Mm-hmm.
in 7 years. What part are you actually buying?
Okay, I'm glad you asked that. It's almost like I asked you to say that or something. Okay, because that's perfect. I'm gonna just fix the. We're gonna go back. I just wanted to fix it while we were here. Okay, so how do we do it? That's all really nice in theory, right? Okay, so here when I'm doing a partial, you really need some help. I love t-value, which I have mentioned before. Have I have you? Do you guys know what I'm talking about? Anyone not know what t-value is? Okay, here it is. So, and because it's a PC only program, I got to run it out of my little, well, this is a virtual box down here. I don't know if you could see it, but it's like a PC inside my Mac, which I don't really get it, but I don't apparently have to get it. I just have to sort of almost know how to use it. Hey, how come it's all black? Come on. Okay, here we go. So here's how I would do. First, I want to get the whole amortization. I want to know, so let's call this is Portland, Oregon. It was, by the way, I did a BPO. I spent $95 to get a broker price opinion. It came back at low 155, high 175. Is very solid value, very nice property, very good area. So I'm thrilled. The collateral is awesome. Okay, to boot. So anyway, Portland note Exhibit A, because when I'm doing a partial purchase and I don't know that I have these forms, I think I had that as a separate download, but I may put, I'm still working with my partial purchase contracts a little bit and getting them, more customizable to me, but there's always an Exhibit A and Exhibit B. So first we have, here's how oops, it's a little bit wonky. Okay. Here's the original note. So I labeled it here. Interest rate is 7%. That's the face interest rate on the note. And here's when he made the loan. So I recreate the whole transaction. So at 9/29/2011, that's when interest started. He loaned them $160,000 of what? What did he loan them? The owner.
Oh, the purchase money.
Right. So his equity, right? He
Hmm.
didn't go like to a bank and get a loan for them and give them money to give to himself, right? He loaned his equity. So when you
Don, is that 7% going to be a problem?
oh, it is. Thank you. Here's another correction. Yep. Okay. So basically, I don't know why I did that. So now we're gonna recreate the whole thing so we can get accurate numbers here. Okay. So I entered 160, right? He loans them his equity at 6%. Okay, now the next line, their first payment will be due 10/29, and if you look at the note documents, they spell all these things out. When the interest starts and when the monthly payments are due. So how much are the monthly payments again? They were
Yeah, 959.
559.28, right? and the
Yep.
84 of them, right?
Yep.
This number we know was we already got the amortization based on 30 years, but we know there's going to be a balloon, so we might as well just stick it in. So we know that on 9/29/2018, they gotta figure something out, or the guy's going to do a loan modification, right? Last payment. Okay, here's what the amortization schedule is. So this spits out the amortization. So did we get this right? 160 loan, 83. Okay, that's the balloon payment that's due at the 7th, at the 84th month after this loan was made. Okay, 144. So right now we can see, what we see, it had 4 months of seasoning. So we can see that as of the 1/29/2012 payment, the balance was not very much below 160, right? 159,358. So that's the balance like right now, or at the time a few weeks, just a little bit ago when I bought this note. That was the note balance. And then I bought 43 payments, right? Wait, did I tell you that yet? Did we even get to
Mm-mm.
that? No, I
No.
forgot. Okay. So we'll come right back. Now let me see if I can sneak out of this. It's really kind of funny, but kind of cool, but kind of weird. Okay, so all right, note holder needs 60,000. Now next slide. So now this is how I figure out how much of the note I'm gonna buy, right? He needs 30,000, so I'm gonna put that in PV, right there at present value, because that's how much he needs. I already know the monthly payment should still be in there at the 959.28. And I have to figure out, well, what do I want to make on this? And I'd like to make an 18% yield, especially on a smaller note of size, because then there's some room in there for me to have some positive cash flow from this thing. And you can make the numbers look decent enough that it doesn't offend anyone, and I'll show you. We'll get to that in a minute. Okay, so 18% yield. Now I want to solve for N. How many payments can I buy, right? So if I give this guy 30,000 and I want an 18% yield, that means I need to buy 42.53 payments. Well, it's hard to buy a partial payment, so we just round up to 43. So let's just do that. Okay, and now I'm going to solve for, now what's my yield going to be? It's going to be 18 and a half, right? My effective yield buying half a payment more is 18 and a half instead of 18 I was going for. That's great. There's 4 months of seasoning. I'm buying these 43 payments. So we know that at payment number 47, that's when the seller gets the note back. That's when, because I'm going to take a full assignment of the entire note. I'm not just taking I get the whole $160,000 note for $30,000, and that guy has to trust me professionally, and I have a notarized, documents and everything like that. He has to trust me to give his note back. Because if I really was going to be a creep, I guess I can make his life hard, but anyway, so that's where it really helps to have a good professional references, and if you're licensed. To me, that's been a help because people can look me up with the Department of whatever, Secretary of State, my corporation. They can look up my DRE licenses. I have a business one and a personal one, so people can check me out, and it helps them feel comfortable, that I'm on the up and up. So anyway, so let's figure out, probably my numbers are all off, so let's figure out what's the amortization, at 47. So I love my t-value. Wait, where is it? Right here. Okay, so I wonder if you guys can see this okay. I can't make it, I don't know how to make it bigger. But can you see it at all, Carlo? Or is it too small?
Yes, I can. Yeah.
You guys can't see it? Okay. Okay, so anyway, so we know the balance is 159 something right now. Okay, what's the balance going to be at payment 47 when the seller gets the note back? So I go over here to payment 47. That means after my last payment to me as the investor is going to be August 29th, 2015. And after I get that, oops, Gosh. My mouse is going nuts. Let me get a different. Wait. Wait. It's still jumpy. Okay. Anyway, it's 151 585. Let's say 151 585. Okay, so that's going to be the balance of the note when he gets it back. So now let's go back out. Let me go back over here. What did I say, Carlo? 151 585, right?
585. Yeah.
Okay, 151 585 plus 30,000. So he's going to still, when it's gone down so little. Look, in the 43 months that I'll have it, the note balance is only going down from 159 to 151. What is that? $8,000. I gave him 30,000, but the balance on the note's only going down 8,000. How is that so? Why? Why is it in this case?
It's all just paid to interest.
Right. On amortized loans, the beginning is all interest, almost all interest. Now, if this guy had, a lot of years of seasoning and I bought the same amount of payments, the note balance would go down much, much more. But so, does this look like a decent deal? Look, he gets 30,000, and when he gets the note back, it still has a balance of 151 and change. So overall, he's getting 181 for his 159 note. So it looks fine, doesn't it? Doesn't it look like, oh my gosh, what a great deal? Okay,
Yes.
so now let's look at how, does anyone have any questions? Let me stop for a second. Is there any other questions? Did I lose anyone on any part of it? Because I want to just show you the next step of it. Okay, so now, time flies, it's already 5:30, my gosh. Okay, so now I want to figure out how do I find out how much of his note I really bought? And then how do we figure out who gets what if that person refinances, at month 24? Because it's not, obviously, I am not entitled to the whole note. I only bought a partial, and he's got his tail end that he's invested in. So we got to figure that out, right? How much did we buy? So where's my calculator thing? All right, so we're buying 43, so let's put N back in there. I'm going to clear all just because I never remember where I was. So 43, that's how many payments we're buying. The face rate, interest rate on the note, 6%. Okay, because I'm duplicating the original note except for the amount of payments. And I know the payment I'm going to receive is that 959.28, and I'm making a negative number, stick it over here in payment. Now I'm going to solve for PV, because that'll tell me how much of the note I really bought. Okay, obviously my numbers are wrong, so because I base that on 7%. Does that make sense?
Oh.
What? Talk.
What do you set? What was the future value set at?
Oh, that's 0 because I don't need.
Okay.
See, the balloon's not my problem because I'm not going out that far, so I don't even need to think about it.
Okay. I got exactly what you got.
Okay, so now I'm going to change my numbers to 37033. Okay, 37033. Okay. So let's figure out what kind of a discount. So let's take 30,000. Oops, where's my thing? Okay, so 30,000 divided by, that's how much I paid for how much I bought of the note. I bought 37,033. So I basically giving them 81 cents on the dollar, 81% of the value. Now that's pretty good. I mean, 18%, probably a lot of people go, wow, that's a really high percent, especially with all the safety. Yeah, and all things considered, 80 cents on the dollar or better is really good. Okay, so it's a fair deal for everybody. So here's what I got to do. Now we got to keep this number in mind right here because we're going to go back over to t-value. Okay, so this is going to be our loan amount, okay? We're going to call it that. to get the early payoff amortization schedule. So I'm going to save this. So now we're going back over here, and it's got to find it all over again. Woo, that's a crazy mouse. All right, where is my other file now? I saved it, obviously saved it wrong, but that gives you a chance to see me do everything from scratch, so hopefully that helps a little bit. Hold on a second. My gardener needs to be paid. Hold on. Sorry about that. I just couldn't let him go unpaid. He had a bad accident over the holidays, and you know, he couldn't work for an entire month, and I know he's scratching. So sorry about that. So here we go. Let's figure out the 6%. I got to do everything over again. Delete line. Okay, now I make the start date of my loan. It's not really a loan, but that's how this calls it. I make it pretty close to when I bought the note. So I bought it right after the January payment. So what was this number? How much of the note did I buy? 37,033, right? Okay, and then I'm going to get the whole thing. I took assignment of the whole note. That means he assigned the entire note to me. He endorsed it to me. Plus, we recorded an assignment of deed in the county recorder up there, and he said to his note payers, he said, "Hey, thanks a lot, and you know, for the next few months, you're going to be sending, you know, your payments over here." And she'll be sending you a letter soon. So then that's how we know how for the investment to switch over. And then I made sure that I'm covered on the insurance policy in case the property burns down while I'm receiving my part. I also make sure that I have a title endorsement or some, you know, there's a variety of ways title coverage can actually happen. But anyway, so I have title insurance, hazard insurance. I take endorsement of the note. He sent me the original note, the escrow, the title company FedExed it to me at closing. I got the recorded version of the assignment of deed, and then I said, okay, it's fine for you to disperse funds, and we're all good. So that's how that works. So anyway, so I'm receiving the next 43 payments of that. So now let's figure out the amortization schedule. Voila. So we know, here it is. We know that at any point, at any date that this pays off early, or if there's a foreclosure, we know what my payoff is at any point. See, this is my payoff on the right here. And that way, anything above and beyond what I have purchased and what I bought the rights to is going to be credited back to the original seller of the note, and that's all specified how that works in the partial purchase agreement that I have.
Wow.
So it's Exhibit A is the face note the way it was written originally for reference, and Exhibit B is the early payoff, and you know, just saying, gosh, this is only how much of your note that I bought. I bought $37,000 worth. Okay, so any questions? I know it's kind of a lot, but is it starting to make sense?
Yeah. So then if he quit paying on that note in the middle of the term you own it, you're fully in control of it. It's the first lien. You're going to foreclose on him.
Right.
And then once that's done, you'll get out of it from the sale of the house what you can, and any remaining amount goes then to the one who sold you the note.
Exactly. But we
Okay.
have to count that. So, oops, I'm trying to get out of this thing. Okay. Yeah. So the way you write it is obviously, you know, it's kind of like having a small first with someone having a large second behind you who has a lot of financial interest. So guess what? He said, I know these people are gonna pay, and if they don't, I'll pay you. So actually, I bought this with recourse, which meaning he's guaranteeing me the payments, and you know he's gonna do that because he is not gonna leave me any of his equity on the table. I love this
Right.
deal
He'd
because
lose a lot more if he didn't.
this is not this. Everybody is lined up with my life going simple, and that's the way I like it. I'm not going to have a headache, and I just want my little payments to come in, and I don't want to worry about it. So then when I bring in another investor in on this with me, who's maybe it's their first or second note they've ever done in their whole life, and this might represent, maybe all they've got is $60,000 in
Mm-hmm.
their IRA, and we can't afford to be risky with it, right? They're going to be comfortable. They won't have to know how to do all this. They can just sit back, get their 8 or 9. In fact, I got someone in at 8% on this, and they're real happy with it. And I'm real happy because I keep about 100 out of the 959.28 a month that comes in, I keep about 150, and the rest goes on to my investor. So I've got 150 passive income for the next 43 months. And that's great for me. I don't want a big wad up front. I just want the passive. I want to build little by little along with my investors and use, my access to the deals and my knowledge of how to do it to build my own passive income. So that's kind of one of the big strategies that I'm all into right now. So, although I do the other stuff where you get points and sometimes you just have to do it. Somebody just wants you to flip, just flip me the note. I don't want to work with you, and I just want the whole thing for me. And then otherwise, then okay, fine, I'll just flip you the whole thing. So let's see. What if I was gonna do that? What if instead of bringing someone in at that 8 to 9% range, what if I said I'm gonna sell it to someone at a 10.5% yield, which would be very fair for the safety in this. So what
Mm-hmm.
would that be? What would I sell it for? Okay, if they need 10.5. Well, let's just call it 11. Okay, say, oh, I want 11% on my money. Let's see what I would do. And I'm going to sell them. I might sell them just 42 payments. I might keep that February payment and put it in my pocket. Okay, and sell them starting the March payment. So let's see what I would do there. We know the payment is 959.28. They'll get the whole thing. How much would they pay for that note? Okay, great. I could have taken what I paid for it. I could have made a $3,300 broker fee on that deal, just flipping it to
That
somebody
worked out
else.
better than if you would have charged points. Well, no, you're not. It's a
That's
whole different
true
situation.
because
I'm sorry.
look, what
Thinking.
3.5 points on a 30,000? What would I have made? $1,000? You,
Yeah.
yeah, you can see that I could do really well on here. Let's see if they needed 12%. Um, I'd still make really good commission on a small note, right? 2,700
Hmm.
right there. But instead, I'd rather have my 150 times 43. What do I get? Oh, over time. Look at that.
Oh yeah, much better.
Okay. So I'd rather have this, yes, and then it aligns me. Everyone knows that I'm not going to make money unless the note performs. So that's just an extra layer of protection where all of our interests are on the same side, and then they don't have to
Mm-hmm.
worry that in the worst case scenario, do I have to like foreclose on someone? Most people can't handle that thought process or want to deal with that at all. So then I just go,
Right.
well, it's on me to do it. No worries. I'll take care of it. But the way I do most of these, it's such a small chance that I'll ever have a headache. Now, I wish I had many of these every month because they're so good. I probably, right now, I'm only getting maybe 3 to 5 that are this sweet and clean in a year. A
Mm.
lot of them have little more challenges or different things, but this one's like, oh my gosh, this is a good spin. In fact, someone who's never bought a discount note before in their life just invested in this one with me. So anyway, so that is the transaction review and calculator practice for this month. Does anyone have any questions before we kind of just call it a night? Anyone got something going on that they want to run numbers on? Carlo,
Yeah, I actually do, but I've been running the numbers on it. I'm selling a park in Oregon, and the guy, we've got an asking price of $399. He has a first note. It's an 80,000, a little bit
wait,
more
okay,
at
wait.
6%.
Hold on. How do I add
I'm sorry.
another new slide right here? Okay, I just want to what the heck? Okay, so here's Carlo's deal. All right, so let me just tell me. Let's delete. I'm sorry guys. Okay, so what's the sales price?
Well, the asking price is $399.
Okay, and then what?
He has a note in first position. He owes a little more than 80,000 on it. It's at 6%.
Okay, so did the person really put down 300 and change?
Well, no, I'm working with the seller here, and we've been gaming what he can do. I'm
Oh,
working with a couple. I hopefully we'll get $100,000 down payment, and they'll come in, with a cash to new loan and just buy him out. But
okay. So
he
what
he's
you're
he's he's a character, so he might have to do some seller financing, and you'll learn a little more about that as we proceed.
okay. So basically, the total carryback would be $299, right?
Well, that's part of the scenarios, and I've been creating a spreadsheet so that now that I've seen this, so that I can work these kind of things out, because he's got two notes. One is an 80,000, a little more note at
But not
6%
on this property.
on this property.
Oh, he owes a
He
loan.
he he, he
Oh,
right. He has two notes on the property for 120,000 total.
okay. So he has a first and second. So he has existing financing.
Yes, which is assumable.
Why? Is it a seller carry too?
Um, I don't know if it was the seller, but they're
It
assumable.
was private financing, and they're willing to leave their
Yes.
money at work. So,
Yeah.
do you want me to break it into two notes, and we'll just
Well,
do it?
yeah, because that's one the $80,000 one is at 6%,
Uh huh.
and then there's a $40,000 one
Uh
at
huh.
14%,
Okay.
and so I've been putting in a spreadsheet because we were talking about it over the phone, and I thought, I ought to have a tool that I can just do this.
Mhm.
So we were looking at, okay, if now he'd like to get money out of the deal,
Right.
but so if they come in with $100,000 down, that's okay. He'll carry the rest if they assume the notes. If they
Right.
assume the $80,000 one, that cuts his cash way down, and he carries a much bigger note, and that's the one that has the good interest.
Right.
If they take the down payment and they pay off that second, that's at 14%, which makes a lot of sense.
Right.
He carries more than if they took both notes, but less, than with the
Right.
$80,000
So
note. So I created
basically,
a spreadsheet that just puts that all out in
right. So
out at
if they
once.
bring in 100,000, so they're gonna have 299 overall,
Hmm.
and basically minus 80,000, and they gotta pay off that thing. So he's gonna get 60,000 at closing, less closing costs, right?
Well, I don't know. Let's say they don't. I mean, let's say that the first scenario is that they assume both the notes and he carries the rest.
But okay, if okay, they shouldn't want to do that. But okay,
Well, yeah, because the other one's four. Yeah, right. So the bet. So right from their
unless
point of view.
unless he's going to give them really really good terms on his part. You know what I mean?
Well, I think assuming the $80,000 note at 6% probably makes sense.
Right.
So they'll probably want to get rid of the $40,000 one at 14%.
Hmm.
Let me pull up my spreadsheet.
So then basically he's carrying a 179.
Yeah, 176. That's exactly what it's.
Oh,
I've got them right here.
176 or
Yeah,
179?
176 500. Because I took, I did like some closing costs, and I took
Oh,
that off
uh-huh.
the down payment.
Okay, so all things considered, something like that, and he's gonna carry a second,
He'll
right?
well, that's part of the problem. I mean, he's
Or
actually got a
third.
third.
He'll be in third position, but he's getting his price, right? Is he over the top on value, or is he realistic?
Well, that's pretty realistic. It's just 15 minutes from the beach on the coast of Oregon.
Mm-hmm.
It's a little place. It's got the revenues are, it's in real nice shape. It's like, a little over $40,000 in revenues, a little over 30,000 in net. It's already booked full for 2012. He spends the winters. He's just this side of the Mexican border down in Arizona. He's got a host, managing the park in the winters. So
Hmm.
it's a nice little lifestyle kind of place.
Right. Well,
Um,
here's one. Like, do you have a buyer for it? You said,
well, I have
or are
I
you the
have
listing guy?
I have several interested people here just really in the last week because we've had a bunch of little looky loos that they don't have any money, and it's just, it'd be nice,
Right.
but
So
sorry.
how much? Like, what does the PNI have to be in order for someone to make a living doing this? So let's reverse engineer what a buyer could realistically pay.
Hmm.
So what would that number be?
Well, that's what I was looking at on my spreadsheet here. If they, because I was looking at if they, we figured he's making about, um, let's see, in net, well, let's say 3,000 a month. So we were a little more, but so I'm putting a spreadsheet together just to look at it, and I looked at what the different scenarios are for them paying off those liens and him carrying the rest. And I haven't gotten much further than that because I've just been working on the spreadsheet to analyze it and try to
Right.
come up with a way to
So
game how much interest rate he could charge.
he only has 3,000 a month after debt service and
Well,
expenses.
no. Well, see, right. He doesn't.
That's pretty
Um,
thin because now you're talking. Let's double the more than double the debt service.
well, yeah. Let's say his net's about. Let me just do this real quick. Um, so yeah, he's it's real thin. That's right. And so
So someone's either
it's
gonna have to come up with more. Okay, let's go back here. Do you off the top of your head know what's the payment on the first note?
yeah. I've got that in my notes. It's like 650, a little less, $643
All right,
a
so let's
month.
do that, and then you on the second. Oops.
He's gonna get that to me. I've been I'm trying to get the information out of him. Um, and
So,
and just to put this in perspective, and why he probably will have to do some kind of seller financing. When I asked him for his Schedule C's, he said,
oh.
"What's that?"
Oh gosh,
So this is
it's not a
some of these little
bankable.
RV
It's
parks
not
are like
bankable.
this,
Yeah.
and he's come out of I mean, he lost a lot of properties in the last few years, but he's come out. He's been buying notes, selling notes, buying properties, selling properties. And he's got, and we're kind of that. That's not really where we where we usually operate, but but he came to us, and I took the listing, and so here I am.
Yeah. Okay. Well, I mean, let's just for kicks and giggles, and then I mean, we'll just get. We're almost like at an hour. I can't believe it. But
Yeah, I don't want to.
oops. I mean, just for frame of reference, if someone could qualify for a loan and they put 100,000, what would their terms be in interest and term from a conventional lender, an SBA or something like that? What would they get? Would it be 4, 5, 6%?
Well, that'd be pretty generous. I don't know that. Um, the park has solid earnings. It's in good shape. Its earnings been pretty steady. It's a small park. I mean, and
No, I
it's
just mean
full
that if
basic.
they could get, like, the guy actually had good records and it showed the income. If they were
Hmm.
getting an SBA loan, do you know kind of what the market rate of the banks is right now? Like, if is it
Well,
5? Could they
in
get
other
five
ones I've
percent?
looked at like 6.5.
Oh, really? Okay.
Yeah,
So let's put 6.5 just for this is just for reference. And
sure.
would SBA amortize over 30 or would it be 20?
No, usually not. No, I mean, if you've got somebody who gets RV parks, they may do 20 or 25, which is what we really try to find. That's the real hard thing, and there's not a lot of people with experience lending into this market, and they see it as very risky.
Right. So let's just put 20-year amortization. And what's the monthly payment on that? So that would be, that would be a typical and very market uh, monthly payment, P&I payment.
Which would leave them only 400 $500 a month, or a little more, maybe $600 a month
See,
spending
that's
money.
not very much. So let's look at the payment here. So let's try to duplicate the numbers. So if they're going to take, I'm going to, so if that's their P&I overall minus, gosh, yeah. I mean, they can't even buy groceries for 500 a month unless I don't know what they eat or don't eat. But
Well,
do they have
yeah. So
laundry
obviously
machines or
we're going to
something?
probably have to bend some on the selling price. The
Even if I
here's the
sit,
profile.
yeah,
Here's the profile for somebody who would buy this park. They're retired. They've got a retirement income. They love the little beach community, and they've got a little ongoing income. He's going to have to come down on the price or carry it at, well, very low interest rate, which
right.
isn't really what he wants to do. He's kind of stuck between a rock and a hard place, and yeah, I mean, I'm he'll have to come down on the price. There's no
Well,
doubt about it.
my thing is he should probably it'll free up more cash flow for everybody if they can just take the down payment and pay off this.
And pay that one off, right?
Right. And then he's going to have to carry more in the note and take less at closing. It's kind of, well, which way do you want to go? You can't have your cake and eat it too. Do you want your price
No,
or do you
I've got
want
it where if they pay off that second note, then he has to carry 216,500.
okay. Yeah. Okay. And we know that if if we say whatever that number was, right? If that's normal P&I that someone could normally get if they could make conventional minus the first
A
so
lender'd be looking for 1.5 debt service coverage ratio.
right. So this is generous, but let's just say then that's how much they have. If you take what they can afford and still make it worth it for them,
Mm-hmm. Mm-hmm.
minus this number is then left over. This is how much they have to service the second, right?
Mm-hmm.
So,
Mm-hmm.
I mean,
Okay.
so then I would go, well, over what, 20 years? Then what would the interest rate be? Well, actually, he could make 6.25. That's actually not too bad. You,
Well,
you
that's
follow?
why. I mean, he and I were just talking it, kind of gaming it out, and I saw it as an opportunity because to start to kind of build a tool so that I can game these things out. I think like a lot of sellers, he's probably not going to get what he's hoping for it, but we'll see what comes in, and
Yeah, well, that's great. I mean, this is the conversation that this whole thing is about.
mm-hmm.
And if he didn't have any loans, then he could definitely, I'd buy a partial into that as long as someone had a good, healthy down payment into it. I mean,
Mm-hmm.
he can't do that now because it wouldn't make sense, but at least he
No.
could get
Well,
his
I don't.
price and he
Yes,
can get
I
some
don't
cash
see there's
flow.
any way somebody would really want to buy a loan from buy this from him. So unless he'll take a huge discount on it. He's going to lose money at one end or the other end.
Right. I mean, the thing is, he's got to take terms because to pay off 120, I'd have to buy almost his whole note. It's not worth it. You
Mm-hmm.
see what I mean? But if he carries the second like you said he should, he can at least get his price and get some cash flow. Or like if someone coming in has like lots of pension income and they don't need the park to do anything
That's what
except
I'm looking for. It's
carry, if it
exactly
can,
the profile that
yeah,
fits this park.
right.
It's a nice little beach community, lots of arts and crafts shops. You're right there at the 15 minutes to the ocean, 15 minutes to the mouth of the Rogue River. It's, Oregon. It's just nice.
Yeah. So then they could even pay him more per month in exchange for a lower interest rate. You know what I'm saying? Like
Mm-hmm.
if he wants to maximize, more money sooner instead of waiting 20 years, then he can say, "Good, I'll take 2,000 a month, and at 1% or something, or some
Yeah.
graduated payment or something, so he can
Well,
maximize the
those are very
money.
helpful to me comments because I've been just looking at how do I break this out and game it out.
Yeah. So, well, hopefully that was helpful. I sure appreciate your participation, and it's always fun chatting these over. And so awesome. So I guess we're at an hour. So I guess we're done. But thanks a lot. And if you have anything that comes up afterward, email me, and I will do my best to get back to you as soon as I can. So have a great night, and I'll catch you next time. Take care.
Great. Thanks, Don.
Uh-huh.